Being a chartered engineer, acquiring membership from certified management accountants supported me immensely to become a chief executive officer of a reputed company. CME is not only producing professional certified accountants, they have been developing their skills through continuous professional development programs. CMA is keen to develop their communication skills as well through their CMA program.
CMA for creating the pathway to being a world-recognized management accountant.
Ayubowan. So welcome to the module of insurance. So especially we are facilitating you with the module of the insurance. So you are going to face in advanced GCE advanced level examination in 2022. So we are facilitating you in this module which can earn more than 15 to 20 marks. So this is going to be a supportive service, especially I think I want to explain you, especially you can have more marks from this module, and this is not a very complicated or a tough lesson which will important for you especially in your day-to-day life and for your examination as well. So I think throughout this, especially in this insurance module, we are going to cover the risk insurance, the risk agreement, and we have insurance principle and life insurance and general insurance. So these modules we are going to cover, and especially in your syllabus, they have allocated 15 hours for your module. So which is a weight with the 15 hours which will provide you more than 15 to 20 marks. So it's going to be very important for you. I think during this limited time frame, you will be able to get more kind of information and idea about what is insurance and what are the principles and what are the kinds of insurances. So let's move on to the lesson. So first, so the basis, number one, the fundamental or the rationale of this insurance started from the risk. Yeah, in the day-to-day life even we are facing the risk. We don't know once we are driving. So it can be we have a chance or a probability to face for accident. So there's a chance, there's a probability, we have a risk. That is why we are having a motor car insurance. So that is the main rationale. So the risk, so we are going to explain the space of occurring damage which can be estimated financially is known as the risk. So especially we are going to use that definition. So it can be a fire, it can be a theft, it can be a loss from business, different kinds. So that's the risk. We don't know in day-to-day life, we have so many risks which we are going to face. The explanation for the insurance especially is coming from the agreement between the insurer and the insured. So where they have made an agreement and insured where they are paying the premium to the insurer, where insurer is agreed to pay the compensation at the end of the day once they are actually facing the risk. So that is the agreement between the two parties, insurer and insured, right? And we have the risk. Number one, next question which is arise in our mind is all the risk is possible to cover from this insurance. There's a problem. No, all the risk we cannot cover from this insurance. There are some deviations, there are some characteristics you should follow. So that is what we are going to discuss in this, especially in this slide. So there are insurable risk and non-insurable risk. So especially there are characteristics which will help you to distinguish between what are the insurable risk and what are the non-insurable risk. These characteristics are very much important, especially sometimes you might get some small case studies which will consist of 4 to 5 lines. So you should be able to identify whether this is an insurable one or non-insurable one. So it can be forecast. So in an insurable risk, it can be a forecast one. So you can forecast whether, yeah, this can be happen. There's a chance or a possibility to happen in the future. And maybe happen can be calculated in terms of money. Definitely, to pay the compensation, there should be a value, there should be a quantification, or there should be a monetary value, maybe in LKR or rupees, there should be a monetary value, right. It can be happen in future in a random basis, and we can forecast, and we have the chance of calculating in terms of money. And the next one, it should be happen in a random way. There can't be any pattern. So especially if there's a pattern, then it's not going to be a risk. So we can't insure that particular thing. Definitely there should be a random way. Random, we can't forecast, or we can't assume in this particular date this is going to be happen, definitely. And the loss happen not be combined with any other losses. It can't be combined. It has to be an isolate one. There can't be any combination which artificially created. It should be definitely an isolated one. And it should be a verifiable. Verifiable means the date, location, exact time, it has to be verified perfectly. So once you are facing in a motor car accident, the person is from the insurance company is coming, and they have identified in which date, which time, in which situation you have faced, everything they are going to verify. So verification is important in the insurable risk. And the examples are given: motor accidents, fire in buildings. So these kind of things are the great examples for the insurable risk. So then you can be able to get some idea. So then what are the non-insurable risks, right? So it can't be forecast. You can't forecast this kind of a thing, or this is going to be happen. You can't forecast. And it can't be, it is sometimes you can't forecast, and you can't calculate or quantify in terms of money. You can't give exact value, right? This is the value which can be created. Because of the loss, you are making this kind of a value. It can be 10 million, 20 million, 50 million. So you can't assume, or you can't give any kind of a value. And loss should be in a regular way. For example, every week, Monday, 4 p.m., same thing happening. There's a pattern. So there's a pattern. So it's going to be happening in a regular way. Regularly it's happening. So this kind of a thing is regular. Pattern is there. We can't definitely cover through this insurance. And combined with any other losses, there's some relationship combined with other losses as well. So I have explained it has to be isolate one, and it should not be verifiable. So you can't exactly identify the time, date, when it's happening. All these things, it's very unlikely to happen. You won't be able to identify all these things, right? So next thing is, why the insurance is important. So that's the next question. What is this contribution importance of this insurance? Especially I have told you this is started because of, especially in the marine related things, because of that this insurance actually executed. That is the rationale, that is the fundamental starting point. After that it has been spreaded. Later on it's expanded for life insurance and fire insurance, and it's got money in transit, personal accident, liability insurance, spreaded. Now we have so much of insurance products. So but the starting point is that, especially for the marine, they have started, later on expanded. That's the reality. So especially the investors. Investors are the people who are investing money and start new businesses, and they are contributing a lot to the economy of a particular country, because we need. So what happens if there is no any kind of a insurance mechanism? The riskier businesses they are not going to start. Why? They have a problem. Once we started, we don't have any coverage, we don't have any support once we are facing a loss from this business. But once the insurance is there, they knew, yes, we can start, we can run the business, but once we have some kind of a loss, once we are facing a difficulty or any kind of a thing, insurance is there to cover. That's why most of the riskier businesses started. That's a good supportive for the businesses to start and grow, and it would be helping for the economic growth as well. And receiving protection in terms of money when disabled or at death. For large organizations, there are large number of crowd or people working. Maybe there are thousands of people, 10,000s of people, so many large scale organizations. So using this insurance, companies can provide a very good protection, right? You have this health insurance, you have this personal accident coverage, so you no need to worry. We will take care of you. We will take care of your family members, so that the assurance can be guaranteed by the organizations. So that's a very good important thing. So therefore, the employees even have a very good confidence, and they are really satisfied. They have that confidence, and they can do their works without any confusion. So that's also there. In a death, even we can't recover the death. You have to keep in the mind. But the thing is, they can provide the financial value or financial contribution for the people who are depend on that person. That's the main important thing. And capital for the development of the country. The insurance companies, they have a pool of investments. Once they have get the money or the premium amounts, they have created the investment pool, and they are keeping some percentage for their day-to-day expenses, like for example, like to pay the losses, to release the payments and compensations, all these things they have keep some kind of a percentage. The rest of the things they are going to invest, maybe in capital markets, maybe in any other opportunities they are going to invest. Then what happens, these investments would be help to expand the capital market of a particular country. Maybe stock exchanges and in the listed companies they are investing. So they are getting a benefit, and it's other way around going to important for the economic growth and the development of the country as well. And finally, the international trade actually has been improved because of this insurance, because we are in the globalization kind of a particular area right now. We are connected. We are not isolated countries. So we are connecting with other European countries, Asian countries, Middle East countries. So what happened, this international trade started because of this insurance, especially the marine insurance. If there is no any marine insurance, people definitely give up on this marine industry. Because of that marine insurance, people do without any confusion, because they knew, because they have a particular coverage. So you have to keep in the mind, because that's very important. Right. So the next point is the insurance agreement. Definitely, there should be agreement between two parties, insured and the insurer. So what happened in an insurance agreement is a written agreement take place when an insured propose form presented by the person who intends to obtain insurance coverage and is accepted by insurance institution. That means the insured person is requesting to have a coverage, and it's accepted by the insurer organization, and between two parties they are taking place agreement. It has to be in written form, and that insurance policy is the written certificate, written document in between the two parties, and it's the legal document actually. It's a legal document, insurance policy. That means all the terms, conditions and other things would be included in this insurance policy. Maybe it can be a life insurance, it can be a general insurance, whatever, it's going to be a written certificate issued by the insurance company. And there should be definitely two parties would be involving. We have to, first party would be the insured, the person who is requesting the insurance coverage, the person actually who is proposal of the person who intend or obtains the insurance coverage. So that's the main idea in the first part, insured. And insurer is the person who is accepting the request and having specially the insurance. So that is what we known as the insurer, or the simple terms we can use insurance company. So what happened between two parties? This one party, insured, is requesting, insurance company would be accepting. So this is what the two parties. These two parties should have to be the agreement. Then we are ended up with insurance agreement and the insurance policy. Keep in the mind, definitely this insurance agreement should be in written format. That is really important in this insurance. So you have to keep in the mind there are two parties involving. Number one is the insured party who is requesting, who wants to obtain the insurance coverage. Number two, second party is the insurance company who is accepting that request and who is providing this insurance coverage. So that would be the two parties who are involving. Right. The next one is the elements which we need to validate the insurance agreement. So, according to this law of contract also applying in this context actually. So, there are so many facilitations or especially the elements which is required for an insurance agreement to validate. Number one, it's the idea of a legal obligation. There should be a legal obligation actually, because in the second point I would be coming, the insurance offer or a proposal, the request should be there. Third one is the acceptance, the party should have to accept it, and the legal validity also important, and finally there should be have a legal obligation by the parties. It can't be enforced in the. So, the idea of the legal obligation means there should be legal. For example, the husband can insure the wife's life and the employer can insure the employee. So, that is the relation, that is the legal obligation. Apart from that, I want to say in Sri Lankan context, according to the legislations, the minority people, the people who below the age 18 can't go for any kind of agreements. It is validate and it is also in line with this insurance agreement as well. Therefore, they can't go for any kind of agreements, minority people. So, on or above age 18, they can go for the valid insurance agreements. So, that is another one condition. And next one is there should be an offer. For example, I am the person requesting a life insurance. That's as you assumed as example. So, what happened? I am requesting, yes, I am so and so, I need this kind of a insurance. So, I am offering, I am requesting. That's from my side. That's the one side communication, one side. I am requesting. That's open for the insurance company. So, what happened? The insurance company also come into the scenario and they would be saying, right, so you are so and so, your occupation is this, you are earning this much, right? According to that, you have to pay this premium. If you are okay, then we are going to accept. So, we are offering, that means we are requesting. Once the organization also coming up with some kind of a counter argument or counter reply, then if they are agreed, that means the insurance company also accept it, yes, we are happy to have it, then we have an agreement. So, we have to satisfy that legal obligation as well. Then the legal validity, it has to be a legal validate. That means the insured person, the signatures required, insurance company signatures required, that means embossed seals, all these things required. Terms, conditions, everything, there should be date, everything should be there. And they have a real legal obligation to have it. It can't be forced to do. There should be have the consent to have this kind of a legal obligation. So, this is really important. I think that's why I told you according to the law of contract, the contract law also applies here. So, definitely there should be a legal capacity. Number one, minors can't go for the insurance contract, that means below age 18. On or above age 18, they can go for legal contracts and there should be offer. We have to give the offer and other party should have to accept it. If they are not accept, no any legal requirement, no any legal agreement. And finally, there should be have ability and the legal consent. It has to be in line with the legal format. All these things once we have done, we have a validate insurance agreement. So, that is really important because we can't go beyond, because these are coming from legal aspect. Legal aspects we have to fulfill. Otherwise, what happen if there's any kind of issue happen? So, once we are going the courts, they would be investigate whether this is a validate insurance agreement or not. So, we have to fulfill number one, whether this is okay or not. Right. Now, we are moving to the insurance principles, which is very much important, the insurable interest. So, we have some small cases, which one line, two line cases, which will help you to understand what is this insurance principle means. Later on, we will be explaining in detail in the next couple of slides, but we will start with some small cases. Why I am selecting several cases? There are some past paper questions even asking you not only this theoretical parts very straight away, they would be asking especially maybe like they are using 3 or 4 line cases and they would be asking what kind of insurance principle is deviating here, or what kind of insurance principle is important for this small case. So you have to come in up with your straightaway answer. You have to read the case, understand it, you have that theoretical knowledge, then you have to come up with the real solution, the practical. So that's why I have selected a few more cases. It's coming from your syllabus as well. Though Sahan's only relative is his elder brother, Sahan cannot insure his elder brother's life. The insurable interest is no longer there. But if there's husband and wife, that's okay, because husband and wife relationship is a legal one. It's a legal one. And employer-employee relationship also a legal accepted one. Therefore, there's an insurable interest. But Sahan won't be able to insure his brother's life. It won't be accepted as an insurable interest. So you have to keep in the mind. Next one, statement 2, utmost good faith. Utmost good faith. Ranjani concealed her sickness when obtaining the insurance policy. Compensation cannot be paid. That means Ranjani is hide some kind of a sickness which she thinks is not important. It is not suitable. Purposefully she may actually conceal, not reveal that part. Then what happened? Once the real situation happened, once they are trying to cover this compensation, insurance company get to know she has purposefully concealed this situation, not revealed. Then what happened? Because of this utmost good faith, insurance company won't be able to settle the compensation. So these are the real scenarios happening, because people sometimes not aware about these situations. Once they are facing the situation, they are going to blame for the insurance companies. I think that this understanding is really important. That's why I told you this is not only for the examination purpose, but it's very much important for your day-to-day life, because in your future as well, because you are being the citizens of Sri Lanka, or you might be in a foreign country or whatever. These are very important. These are the fundamentals. And the third one is the indemnity. For example, if you are facing some kind of a loss, that means, for example, is Devaka Motor is insured for 15 lakhs. Now it has been they faced with a loss or accident and damage for 2 lakhs. That's fine. 15 lakhs actually insured, and 2 lakhs is the damage value. So the compensation, they are paid according a maximum tier of the 2 lakhs. They are not going to exceed this 2 lakhs actually. That's the maximum tier is the 2 lakhs or below that level. So that's the main idea of the indemnity. They are going to recover or do the payment, release the payment according to the damage value. Otherwise, what happens if they are paying more than that, they can earn a profit out of this insurance. Then they are going to deviating with the main insurance principle. That is why they are using this indemnity principle to stop this kind of situation which can create of making profits out of this insurance. Then people would be misleading or misusing this insurance concept. Number 4, contribution. So here contribution means Bandula insured his factory for 10 lakhs in each 4 companies, 10 lakhs in each 4 companies. The compensation, so assume, so Bandula factory made some kind of an incident and there's a damage of 5 lakhs. So Bandula won't be able to get 5 lakhs from all companies. That means there are he insured his factory in 4 companies in the term value of 10 lakhs in each. 10 lakh, 10 lakh, 10 and 10. And he made the actual damage of 5 lakhs. Now his damage value is 5 lakhs. So what happened is Bandula is having a chance of having 5 lakhs from each company. So if he get 5 lakhs from each company, so he is getting 20 lakhs. That means the actual value is 5, he is getting 20 lakhs and there's a 15 lakhs deviation. So he can have a profit of 15 lakhs. It is impossible. It can't be happen in the insurance. That's why they are using contribution value or the contribution principle, and they stop that position and they say, no, you can't have that kind of a compensation. Once you are having that sort of a loss, the 4 companies have to contribute based on the ratio value, how you contribute for the premiums. Then all these companies get together and have a ratio how this bandula is actually contribute for the premium. Based on that ratio, they are agreed and pay the maximum of 5 lakhs. Get together and pay the maximum of 5 lakhs for the bandula's damage, factory damage. That's all. Other than that, they can't make any profit out of this. So you have to keep in the mind. And the next one is the subrogation. So subrogation is also important. That means before the payment of the compensation, the debris of Dinesh lorry which was damaged by accident should be handed over the insurance company. So there are some debris, the things, residual things. So all the things, once the insurance company is paying, so they can't keep as it is. They can't keep with them. They have to hand it over to the insurance company. Why? Because all these rest of the things or the residual things after the accident even, they can sell and make a profit. So because of this subrogation, they can't make any profit out of this insurance. They want to stop that part. That's why they are applying this principle, subrogation. Next one, the proximate cause. Proximate cause also very much important in the both the side, life and general insurance, especially Suresh business insured with the only risk of fire. Under fire insurance, it has been destroyed by terrorist act. So here the situation is where Suresh business, he have the actually the fire insurance, but the thing is his actually the business is destroyed because of a terrorist act. But the coverage is coming from where? Fire insurance. He had the fire insurance, but actually the destroyed or the damage made because of the terrorist act. Now two kind of reasons are there. He take for the fire, but real actual one terrorist act. Since the damage was caused by the riot, the compensation cannot be paid. That's the argument. So the proximate cause means the more valid reason to happen any kind of a loss or a damage. So if that cause or the thing is covered from the insurance policy, then the insurance company is going to pay the amount. Otherwise, they are going to hold it. Keep in the mind. Especially in the life insurance companies, I want to share this. They would be applying this proximate cause as well. The first one, in a life insurance company, they would be searching is whether this death is a suicide case or a non-suicide or a natural death. They are going to search number 1. Because if it is a suicide case, insurance companies are not going to pay as compensations. But if it is a normal thing, then based on that, they are going to pay accordingly. So keep in the mind. These are some additional points and tips which is helpful in your future as well. Right. There are some more insurance principles which we can explain. Insurable interest, it is the definitions also would be there. Some interest over anything where existence of it causes some economic advantage. Once it's lost, even there's some kind of a economic disadvantage. So that sort of a relationship is we are knowing as the insurable interest. In the simple term, what you can say is there's a relationship husband to wife, wife to husband. That's the insurable interest. And legal owner of any property, if I'm owning my own vehicle, I have the legal authority, legal relationship to have a coverage, motor insurance coverage for my vehicle, for my car. That is acceptable. That is what we know as the insurable interest. If I have my own property, I have the legal right to have the insurance. So that is the insurable interest. Next one, the utmost good faith. That means revealing all the information between the two parties. This is applied for the insured and the insurer, both the parties. Most of the time it's like people might thinking it's only for the insured. No, for the insurer and insured, both the parties have this, applying this, especially utmost good faith. Keep in the mind, both the parties have to reveal all the necessary information, especially from the insured should have to provide all the necessary information, background, if it is life insurance, all the sicknesses and other things has to provide. If it is coming from the insurer or the insurance company even, they have to provide all the terms and conditions, what are the other legal requirements, the premium amounts, the deadlines and other exceptional things they have to reveal. I think most of the time there is some kind of a bad image because of this utmost good faith is not going to be have between two parties appropriately. Because of that there is some kind of a bad image regarding the insurance companies. So that is the in society what is happening. The real case is both the parties, insured person. If I am taking the insurance, for example, life insurance, I have to reveal all the things, my behavior, my position, my salary, what are the sicknesses, if I face some operations in past days, all the things, background and what my habits, all the things I have to provide in detail. And the insurance company even has to pay all the regulations, legal requirements, terms, conditions, exceptions, deadlines, everything have to provide. Then that is the utmost good faith. We have a very good mutual understanding between two parties. That is the next one is the indemnity. Indemnity is we are going to pay for the actual damage and helping to reinstate. So that is the next idea of the indemnity. Has been damaged property, payment of an adequate amount, the required amount they are going to pay to the restore the property is known as indemnity. Especially for a motor vehicle or a property, for example, it is given 40 lakhs has been insured and damage is 2.5 lakhs. So only 2.5 lakhs is going to pay. They are not going to pay any single amount exceeding the 2.5 value. Keep in the mind, because they do not want in insurance to make this insurance as a profitable business. Otherwise people would be think, wow, it's going to be a profitable business, we can have more profits out of this insurance. So we can mislead the insurance companies. So that's why these principles are applied and make more professional and keep this insurance in a very professional way. Keep in the mind. That is the rationale of having this 6 insurance principle. Next one is the contribution. Contribution for what? A person can have more insurance policies for the same property. That's all applicable. That is acceptable. When a property insured in several insurance companies for a property or a building or a vehicle, so we can have in 2 more insurance companies. That is okay if you have money. So what happened actually if that property is faced an kind of a loss or a damage, the compensation is going to pay with the contribution of all the insurance companies. That is the rationale and the argument. Otherwise what happened? Each organization is going to pay for the equal loss amount, so the person is getting a huge amount end of the day. So he can have a profit. So that's the problem. That's why property worth of 10 lakhs insured in A, B, C for 5 lakhs, 3 lakhs and 2 lakhs respectively. That's the proportionate, that's the ratio value. And damage for 100 lakhs, 100,000, what happened? So that person is not getting 100,000 directly from A, 100,000 directly from B, 100,000 directly from C. No, that is impossible. What happened? A, B and C, 3 companies get together, and how this person is contribute for the premium. So they take the ratio. Based on the ratio, this loss amount distribute among the insurance companies. Then what happened? 5 to 3 to 2. Then A is contribute 50,000, B contribute 30,000, C 20,000. So altogether you can get the summation of all these 3, it should be equal to the 100,000, not going to exceed the real damage value. That is going to be really equivalent. Therefore, it's okay. So they are going to stop once they are making a profit out of this insurance business. So that's the real scenario. And subrogation, especially settle a loss or a damage, they can't have another kind of income out of this situation. That's the main argument. If they are having any kind of advantage after the settlement of the payment by the insurance company, the legal requirement or the legal ownership is actually within the insurance company. That means if a motor vehicle insured 50 lakhs and destroyed fully, then the insurance company pay all 50 lakhs, fully they are paid and takes over the debris of the vehicle. we can't keep the debris, the residual things. The residual things we can't debris of the vehicle. We have to give all the things to the insurance company. They are going to pay the full amount for the full amount, which is equal to 50 lakhs. We can't keep all the debris. We have to give all these things for the insurance company. So that's the subrogation. So each and every single point they have a clause. That's the main idea. And proximate reason, especially here, once they are looking at what is the real reason is for this damage or the loss. If it is covered from the insurance policy, they are going to pay. That's why I told you for the life insurance and the general insurance as well previously. If they are not covered, they are not going to pay. So that is the proximate reason. That is very important. Keep in the mind. And this is the summary. I think this summary is very much important. Most of the time this is going to be tested in your examination as well. Keep in the mind for the life insurance. So you have two insurance perspectives or two areas, life insurance and the general insurance. For the life insurance, only insurable interest, utmost good faith, proximate cause is only applicable. Why? In the life insurance, we can't reinstate or we can recover this death actually. What we are going to do is we have some kind of a risk of death. What we are going to do using the insurance, we are providing some financial supportive. So for the people who are depend on that dead person, that's all. If the person is not died during that period, once the coverage is over, the person can have the benefit and the amount at the end of the day. That's also possible. In the life insurance, only 3 would be applied in the life insurance out of the 6 principles. But in the general insurance, all the 6 principles are applied without any kind of a condition. Insurable interest, utmost good faith, and proximate cause, indemnity, subrogation, and contribution. All these things apply. And there are some reinsurance and the underwriting. There are especially some kind of a thing where insurance companies have some, they are having some kind of a risk where they are accepting some insurance of the properties and other things, but there are some kind of a threat of having a large amount. What they are going to do, they are going to transfer it for another company. The insurance company also, they are from the scale, they are going to have the same insurance from another insurance company because they have some kind of a threat. That is what we know as a reinsurance. Can transfer the liabilities through reinsurance, the premium charge from the insurance rather low. So what happens, there are some small scale organizations, they are having a bit of a high valued insurance property, so they have a threat. So what they are going to do, they transfer it for another insurance company. That is what we know as reinsurance. So then they also transferring their risk into another. Maybe it's a global related organization and comparatively it is a more large firm compared to that organization. That's how they are going to apply the reinsurance. And the underwriting, normally the dividing, if it is a high risk property, what they are going to do, they are dividing parts. Like if it is a trillion amount of a property, sometimes one single organization can't bear it. What they are going to do, they value. So example 1 trillion, so they divide among values, right, 4 values they have separated and each value is given for each company. Once they are actually facing a damage based on that ratio value, they are contributing for the loss amount. That is what we know as the underwriting. So these are the, especially for like vessels and ships, the amounts are very higher. So their values are billions and trillions. So the large vessel ships, so what happened? Are using this kind of a scenario. That is what we know as underwriting. And their case of accident, loss will be compensated by companies of the amount they have undertaken. That ratio is applicable. So keep in the mind, so this is reinsurance and the underwriting. Right. So this life insurance and the general insurance, especially in the life insurance, mainly the main aim of the life insurance is not recover or reinstate this death, because death is a natural thing which we can't control actually. So what we are doing in life insurance, especially protect a certain person against the losses caused as a result of them is disability or turn into old age. That's the main thing. So there can be disabilities, there can be some unexpected things happening or turn into old age, some diseases or whatever thing to protect that certain person. So once the person is facing a death, we can't recover. We can't give him life actually. So what we are what we are doing, especially through this insurance, is we are providing some financial and monetary value given them for the people who are depend on that person. Then it would be a greater support for the people as well. But if the person, I have told you, person is not died, then you might have a question, so what happened during that period if the person is not died? That person can have the amount as an investment and he can have the benefits. So that would be the real situation. So we are going to have it during some period. There are some variations as well. The life insurance is a broad concept where there are some categories of policies for full time and only limited time. Likewise, there are some categories which is provided by insurance companies. So it can be whole life, limited. Likewise, there are some categories, keep in the mind. But general insurance is consists of so many insurance products: fire, marine, goods in transit, personal accident, liability insurance, miscellaneous insurance, motor vehicles. So many insurance things would be coming in the general. I told you the insurance principles even apply. Life insurance only 3. But for general insurance, all 6 would be applied. Keep in the mind, these things are frequently testing in the examination as well. Right. For the fire insurance, especially can be obtained to cover the losses or the damages which happen because of the fire. Because of the fire may be caused to a person. It can be caused for a person, building or any other property because of the fire. Because of the main reason is happen because of fire. That's why we are taking the fire insurance. But apart from the fire, you can add more conditions there. More policies would be you can apply. That chance or the freedom is there. But the argument is once you are applying more and more options, your risk also going up. Then what happens? Your premium amount also comparatively increasing. So there's a relationship. There's a positive relationship between this risk and the premium amount. Once you are adding more risk, then your premium amount also going up. So keep in the mind. So you can cover extra things: explosions, electricity, terrorist act, crashes, all these things. Tsunami even, I think 2004 we faced the first incident of the tsunami experience. It's a tragic experience. Previously we don't have that kind of a tsunami coverage for the vehicles, but later on we have added. So you can add more things for your insurance. For example, life insurance, maybe for other general insurance as well. But once you are adding, you have to pay an additional amount. Your premium amount also going up. That's the reality. And theft. And theft insurance may be covered to risk that happen to business or home from thievery. So theft also happening. There can be thieves would be taking the things out from your homes or from your business place. It is possible. It can be happen. So what we are going to do, we are having the theft insurance. We are having the theft insurance during using this one. So we can have that coverage. That's good thing. And natural disaster. So we are living in a place where it can be floods, storms and heavy rain. So many things can be happen. We can't think. So in some cases, some large countries, Sri Lanka is a very small island, but there are large countries which they are transport from one destination to other destination. It takes more than 3 or 4 days. That's the real things happening in the world. So what happened there? Natural disasters would be happening. But luckily, our condition is okay in Sri Lanka. But there are some countries, one part have a huge floods, one section they have a windy, stormy, different kind of natural weather seasons are there, might be impacted in a negative way. So this natural disaster insurance help once they are transporting all these goods and the things from one destination to other destination, or else due to any kind of a natural disaster, if they made any losses, they can cover from the natural disaster insurance. So that's a good opportunity and good chance. Otherwise, people might be demotivated. Business people, we can't do this because we don't have any coverage, because we are doing our business with lots of risk, but no chance, know how to manage this. Then they would be given up on some certain businesses. But luckily for the insurance, we are doing that. So we have to keep in the mind. And the marine insurance, I told you at the very beginning, basically the insurance start because of this marine. If there's no any marine, definitely there's no insurance. That's the very first initial step which is started. So you have to keep in the mind. So especially it's for the ships and the goods in the ship. They are covering two areas. Especially you can have the idea once they are coming from one country to another country harbor. It's take maybe 1 month, 2 or 3 months. During that, there's a huge risk. They can't assure. Once they are departing from one harbor in a particular country, until they come for the next destiny, they can't assure. Because there can be any kind of since we have a huge technology or whatever the things, but we can't accelerate the natural things, natural or the weather conditions, all these things we can't accelerate. We are in that particular arena, we can't accelerate since we have so much of technology. So what happened, because of that they are having the marine insurance because of that. So especially it's a great opportunity and great chance to start up the businesses and riskier businesses and continue. Otherwise people have to stop everything. That's a good opportunity. For the marine insurance even there are few coverages. For the hull insurance, that means for this coming for the especially for the vessel or the ship, and these are the cargo, the goods and other things in the ship. Full option, total loss, port risk, maintenance and the construction or risk. There are categories would be coming, they have to pay. And the cargo, even the things or the goods in it, valued policy, open cover and the future time policy, these things would be applicable. So we have to keep in the mind this marine insurance, they have two options, maybe one for the vessel or the hull insurance, other one is for the cargo, the goods which they are transporting through this vessel. So there are two types you have to keep in the mind, right? And we are coming for the motor traffic insurance. I think this is also very much important area where agreement between the owner of the motor vehicle, it can be a car, it can be a bicycle, three-wheeler, van, lorry, whatever, and the insurance company to obtain compensation for the loss occurred from the motor vehicle, people traveling in the motor vehicle and the other external parties due to motor vehicle accident. So that coverage would be coming as the motor traffic insurance. There are three types: full insurance, third party with fire and theft, and third party insurance. For the full insurance cover, they are covering all the things, all the aspects, especially the relevant vehicle, the people who are in the vehicle and all the external parties, means the life and the properties of the external parties cover in this full insurance, full coverage, no any kind of restrictions. So once you are having a full coverage, full insurance, you have to pay a bit of a higher amount. Next one, third party fire and theft, third party. So here fire and theft, so losses to the relevant vehicle might be caused for fire and theft also covered, and all the losses to the external people. External people means for the people who are the life of the external people and the properties of the external people would be covering in this third party fire and theft insurance. That would be the second option. The last one is the third party. Here third party, from the word itself you can derive third party means it's covering only the external parties. External means they are not going to cover the person in it and the vehicle, they are not going to cover only the people, outside parties, external parties. That means the life of the external parties, properties of the external parties, they are going to cover. So keep in the mind, once you are putting your vehicle into the road of Sri Lanka, especially it's a mandatory thing that you must have at least a third party motor insurance coverage. It's a must, keep in the mind, it's a must. But there are options, you can go for third party fire and theft, that's up to you once you have, or else you can go for the full insurance. But third party insurance is a must, keep in the mind. So that's the rule and regulation which is imposed in Sri Lanka. And we have the liability insurance, especially liability insurance, because it's a liability means we have to. So that is, I think, from accounting even you have that liability. Especially it's given by losses caused for other parties. That means once we are doing some kind of a production, transportation, other things, so there are external parties are there. So what happened because of that, there can be some damages happening to the external parties. That is possible. Sometimes we don't think, we are not purposefully doing, but there are chances can be happen. There's a kind of a probability. That's why they are having liability insurance. Maybe we have general liability, product liability and employer liability options as well. So especially the general liability may be relevant business or the ownership of the properties for loss that may be unexpectedly occur from properties or the business activity. Unexpected things happening. Because of the activities, sometimes the roof also would be damaged and it can be damage for a person. So we can't imagine. There are some things would be happen, but we don't imagine. So that kind of a thing can be covered by general liability insurance. And the second one, I think for the general liability, there are some cases reported in the newspaper in Sri Lanka as well. I think if you have read, there are a few cases are there. In second one, product liability. That means once the people are consumed. So if I am the businessman, I am doing a production of maybe it can be a soft drink or it can be a food. So what happens once I have producing and put it into the society and for the market, people are consuming. It can be effect for them. It can be allergies, it can be create some kind of sicknesses, illnesses for the consumers. It is possible. For all these kind of things, losses, damages covered from this product liability insurance. Keep in the mind. So that is the product liability insurance. Once we are doing businessman, that also possible. And employer liability. Here the employer liability means once there are people are working, because they have to sometimes there are some jobs would be they have to stay in the office, but there are some jobs they have to go here and there. Maybe they have to visit the branches, they have to go all around the country, sometimes they have to go for the foreign travels even. There are so many some kind of a deviations, some kind of a segments are there. So what happens once the person is engaging or once the employee is working, he may have chance to face some kind of accidents, illnesses, losses, damages. These are possible. So once the person is in working time and face for any loss or a damage, there's a high chance would be, or it's not actually high chance, but using this employer liability, it can be covered actually. So this is a very good opportunity for the business and the organizations as well. Otherwise, they also have a threat, and the people or the people who are engaging as employees even have some kind of a risk. So we are doing this job, but once we are facing a damage or whatever the thing, do we have any coverage? They have a problem. But once they get to know, yes, we have the insurance, you have this protection, critical illnesses and disability cover, then they have a yes, we have that coverage, so we can claim it. So that would be the very supportive point, employer liability insurance. But you have to make sure this coverage is applicable once the person is working time only, covering if they are made a loss or a damage during that working office time only. And these kind of things sometimes justified by a committee of the organization. It consists of the high authorities of the organization, sometimes and from the insurance company authorized people, and they go through all these medical things, incident and case, and they would be finally deciding. Keep in the mind, so they are not just approve and send, they would be evaluate very critically and try to make sure this is actually a real case. It's a real case, they want to make sure. After that, they would be releasing money. So this is a very good opportunity, especially for the organization as well. And the next one is the goods in transit. Sometimes the goods would be transporting from one destiny to another destiny. It can be cargo, it can be using ships, sometimes is within the country as well. Sri Lanka, luckily, within one day we can go from Jaffna to southern province. We have that chance, but in other countries not like that. Sometimes they have to spend 5 to 10 days to go from one destiny to the next milestone. So therefore what happened, until they go for the destiny, they have a high chance they face an accident due to natural disaster. So many things would be there. We can't sometimes assume. So all these things would be during this travel and transport of the goods from one destination to other destination. They are having the coverage of goods in transit in between. So that coverage would be have a very good supportive. So if they have any losses, any damages made during that particular period, during that journey, they can recover or they can have the compensation. That's a very good opportunity. And next one is the money in transit. So you might be wonder, in some cases, are we having this money in transit? Is it possible? Yes. In some cases, hope you have learned about in accounting the petty cash book. The petty cash book, sometimes you might be learning is 1,000 rupees, 10,000, 20,000. But in reality, in the large multinational organizations, they are using in petty cash maybe 10 million, maybe 1 million for day to day. So for example, they have to bring that money from bank to the organization. There can be these chances. So there's a high chance the theft can be happen, there can be damages would be happen. It is really some kind of a issues would be there. So what they are going to do is the organizations having this money in transit. So once they have the money in transit, no need to worry because they have the cover. If they have loss or theft or what sort of a thing, definitely they can cover all these damages and the compensations using money in transit insurance. So all that, I think this is what we have covered. This is important for your exam and as for your future as well. So I think we have tried as much as possible with you during this limited time. So wish you all the very best for your advanced level examination, which is coming on 2022. So thank you everyone being with us. Thank you again.